Hey, I'm just curious. Have you ever said there's got to be a better way? Now, think about it as if you had to give me an example. Be specific. When's the last time you thought of this? And how long has it been a problem? Have you tried to do something about it? And did it work? How much do you think it's cost you so far? And how do you feel about that? Have you given up trying to deal with the problem? Well, we can help. Okay, as we go through this presentation, I'd like you to ask yourself these three questions. Is there a need for what we do? Are these financial concepts helpful for you? And if your family and friends implemented these concepts, would they be better off? Now, here the headlines tell the stories. More than two-thirds of the U.S. live paycheck to paycheck. 95 million Americans have no life insurance, yet 7,115 people die daily. That's more than twice two 9/11s every day. The average household now owes nearly $16,000 in credit card debt. 51% of American workers make less than $30,000 a year. Nearly half of Americans have less than $500 in savings, and 60% of all workers have less than $25,000 in retirement. Now, I'm sure you know somebody in all or most of these categories, so you would agree that this is a real serious problem, correct? Now, the results of the previous slide, kind of summed up in here. When people they surveyed 100 people at the age of 65, and um, out of 100 people at age 65, only 1% are going to retire wealthy. That doesn't mean that they're, Donald Trump or Warren Buffett. That just means they have a net worth of $5 million or more. 4% are going to end up being financially independent, which only means that they're able to live by the same standards that they did while they were working. And now, if you're like a lot of people and you're not happy with your working standards while you're working, that may not be that great. Now, here's the alarming part, too. That 41% of all people at age 65 are still working, and then 54% are broke, which means they're dependent on the government or a family member just to survive. Now, given that everybody doesn't need to be broke or still working at 65, the difference between the 4%, the 1%, the 5% at the top, and everyone else is four simple things. And number one, they had a plan. Number two, they had financial education. Number three, they have a coach slash mentor. And number four, the vast majority of ownership. Most people can't accumulate great wealth working for someone else. Now, it may be tough, but ask yourself at this point, where do you see yourself finishing? Now, there's 5 reasons people get involved with our company. Number one, they don't like their current job and they're looking for a career change or better income potential. Number two, they love what they do, but earning extra part-time income each month would make a positive difference in their life. Number three, they want to get a financial education that so many of us didn't when we were in school, so they can learn how to win the money game, not just participate unwillingly. They love helping people and making a difference. And then finally, they dream of having their own business. Now, I imagine you can see why most people have interest in at least one of these areas. Now, quick touching on who are we? Primerica Financial Services. Don't know if you ever heard of us, but we're the largest financial services marketing organization in North America. Been in business since 1977, in the most regulated industry in the country, the financial services industry. We have over 100,000 licensed representatives. These numbers need to get updated, but still there's over 100,000. 6 million clients in the United States, Canada, and Puerto Rico. As I said, largest financial services marketing organization in North America. Want to check us out, listed on the New York Stock Exchange, stock symbol PRI, member of the Better Business Bureau, A plus superior rated by AM Best, in the Forbes most trustworthy financial services companies, year in and year out. Delbar Award Service for over 13 years running, and ranked second in customer satisfaction among life insurance companies in the 2015 American Customer Satisfaction Index for insurance reports. And again, 41 years in financial services and still going, not fly by night. And though you may not have heard of Primerica, since we do everything word of mouth, you probably heard of some of these companies. Kind of like a one-stop shop. Whether you like them or not, you're kind of like the Amazon of the financial services world. Like I said, you may not know Primerica if you haven't heard it from a friend, because we do know advertising, radio, TV. Most of everything is word of mouth, or maybe something like you're hearing right now. But I imagine if you look around the circle here, you've heard of many of these companies that we deal with. And since we have such a great distribution, we only get the best of the best from all these companies. Very often they even sell out their own agents in order to give us a product that's better than anything that they can even offer. It's kind of amazing. As you can see on the bottom, our mission is simply to help families earn more income, become properly protected, and debt-free and financially independent. What could be better? Now, what are the 6 roadblocks to financial independence? One, and these are in no particular order as far as frequency or anything, they're just the 6 roadblocks. Debt, high taxes, lack of savings, expensive or inadequate insurance, insufficient income, and a big one, I know it's a problem for me a lot of times, is procrastination. You mean to be doing something, getting started, and you just hesitate to do it. So I imagine everyone watching here falls into at least one of these categories, maybe a few. Maybe you could say which one concerns you most, maybe all of them. And the big question is, has anyone ever showed you a detailed solution for these serious issues? Probably not, or you wouldn't be here. So really, people don't plan to fail, they fail to plan. You might have even heard this saying before. The problem, traditional financial institutions sell you products, they don't provide you with a total solution. What we do is we provide written recommendations that give you options, strategies, along with action steps on how to feel better financially through a financial needs analysis. Basically what this is please don't think me crazy, but imagine if you called up, if you look at this circle with the U in the middle, you have your life insurance, your mortgage, your credit cards, installment loans, mutual funds, savings accounts, 401k, bank accounts. Imagine you asked a representative from each one of these companies that handle your different accounts to come over. You'll provide the pizza, and we're going to map out a financial plan as we get together. How do you think that would go over? More than likely they just call up and have you committed. But that's exactly what we do. We're going to work all these companies as you've seen it before, and map out a financial plan that's good for you and not for the companies. That's basically what normally happens. They're making a plan for you that's in their best interest. So things you need to know, like for instance, what's your financial independence number? Do you know your debt freedom date? When the date that you're going to get out of debt, and don't get around and say the day I die. Well, we want to change that if you do believe that's the case. And financial independent, bottom line is retirement's no longer an age; it's a number. So how much money you're going to need to reach this financial independent number, the FIN number. Bottom line is also, Do you know if your number one financial asset is protected? Do you even know what your number one financial asset is, for most people anyway? So, I'll tell you right here, you're going to earn a fortune in your lifetime. If you average, most people average between 25,000 and 80,000 a year in income. So you can see over a lifetime, you earn somewhere between $1 million and $3.2 million. And I think we'd all agree it's not what you earn, but what you keep that counts. So as we said, this is really your number one financial asset is your income, right? So protecting your family's future. You know, a lot of people have a car, and you're required to have car insurance by law. Average car, say, is $25,000. A lot of people have a home, and if you have a mortgage, you're required to have homeowners insurance. Average home across the country is about $241,000, and you know, if you have a mortgage, you're required to have homeowners insurance. It's a good idea. If you don't, you know, if something happens to the property. But we're not required to have life insurance, right? Yet it's, you know, death is certain, not the date, but you know, that it's definitely going to happen. And yet still a great deal of people don't have life insurance. And the value of the asset somewhere between $1 and $3 million. So hopefully you agree that it makes sense to protect your biggest asset, your lifetime income first, correct? So we help people protect their families financially if they die too soon or they live too long. Now here's a simple financial concept that a lot of people have never heard of, called the theory of decreasing responsibility, which basically means when you're young, you have a lot of responsibilities, but not a lot of money. And then as you grow older, you typically have, if you've saved, you have more money and less responsibilities. So, for instance, more responsibilities when you're young. You have children are young. You have debt, could be college debt, mortgage. You know, you don't have the ability to pay for a car out of pocket, so you got a lot more debt. So your need for life insurance when you're younger is greater because if something happened, your family would be devastated because they have all these things, and they don't have your income to help pay for it. Whereas when you get older and the children are grown, hopefully out of the house, maybe they've come back though, you should have lower debt, and hopefully your mortgage is paid if you're doing things right, and that's for us to help you with as well. So if you look at the point where the arrows cross, that's basically where you become self-insured, where the yellow line is your savings as you put money away, and the green line is your responsibility. So when your responsibility crosses your savings, you're self-insured, and that's where we want to get you as soon as possible. Now, the question I want to ask you is, what life insurance company do you know of that teaches people how to eliminate the need for life insurance? A little crazy, huh? But you got to remember what our goal is, to get you financially independent. Okay, now why don't most people get there? Whatever you've heard, there's two types of insurance. There's cash value and term insurance. Cash value is called a bunch of different names, and you know, they're coming up with new ones every day to try to sell you. First, you have whole life, universal life, variable life, and then term insurance is basically, you know, what they call it's real insurance. It's just purely covering your life. There's no cash value in it. So if you look at the example on the left, you have John and Mary. Couple, age 30, they have $150,000 worth of whole life coverage. Their premium's $218 a month, and we really don't know what their cash value is right now. Same couple, John and Mary, with the same $218 with the term insurance, they're able to get twice as much coverage. Their premium is only $98 and change, so they're able to invest $120 a month, into savings for themselves. And so in this example, this goes out to retirement age of 65. I have a 35-year level term, plus 10,000 on each child for the term insurance. So at the end of the 35 years, they're $120 a month. At 10%, grows to over $459,000. Now, going to ask you a quick, simple question. This isn't rocket science. If you live a long, happy life, which plan works better, the cash value or the term insurance? You know, not a trick question. Okay, now ask yourself, if you die suddenly, what's the better plan? The cash value or the term insurance? And you're saying, well, in both cases, it's the term insurance, right? So the question is, why do most people have cash value? And I can tell you, it's because it's what was sold to you by the life insurance agent. And I could also add to this, it's because they get paid quite high commissions on whole life insurance, and on top of that, a lot of life agents don't have any kind of securities license, which is so they can provide these investments. So they don't want to sell it to you because they can't. So you're probably saying, okay, that's great, Mike, but where do I get this 10%? And very, very, very simple, and I'm going to teach you that in the next slide, called the Rule of 72. Okay, what's the Rule of 72? It's the most powerful rule in all of finance. Einstein said it's the most powerful rule in the universe of compounding interest. So how does it work? You take the number 72, divide it by an interest rate, and that, in a rounding, it's about how long it takes for your money to double. So, for example, you can read the chart with me. Take 3%, the number 3, divided into 72. So your money will double every 24 years. 72 divided by 3 is 24. So you can see in year 0, you put your money into an investment at 3%, you have $10,000. And in 24 years, you'll have $20,000. 48 years, $40,000. Not terribly exciting, but this is how it works. Now, a lot of people think double your interest rate, double your money. So at 6%, again, 72 divided by 6, your money doubles every 12 years. I know this is simple, but just come along with me. So year 0, you have the same $10,000. Year 12, $20,000. Year 24, $40,000. Year 36, $80,000. Year 48, $160,000. Now I know you all do like I did, and you're already looking at the row 3, and if you're quick at math, you know that 72 divided by 12 is 6, so your money's doubling every 6 years. And we can go through all the numbers, but the bottom line is at the end of 48 years, the same $10,000 at 12% is $2.5 million plus. So ask yourself, what am I getting at the bank, and what are they doing with it? And this is your money. It doesn't matter whether you're making this money, it's being made in the markets, and either you're giving it to the bank. You agree with me that that's a pretty expensive toaster that they're giving you, and you don't even get a toaster anymore. You might get a pen. So where do we get these 12% returns? If you're looking at the right, the S&P 500 had a return of 11.66% from 1987 until the end of 2016. And that's just the S&P 500. That's no professional management. So now you just learned this most powerful rule in all of money, and you probably never heard of it before. Most people haven't. So I want to ask you, without introducing this to your family and friends, how would they learn the rule of 72? Bottom line, they wouldn't. And therefore, they're going to continue to get taken advantage of by the banks and the insurance companies that are just taking this money, your money, and putting it right into the same markets that you could be bypassing the middleman, and you could be making $2.5 million over 48 years versus 40,000. They're taking $2.5 million from you. So the choice is yours. Now, what do we need to do here, to get you on the right path? To build your financial house. Now, I think you'd all agree that whether you have a construction degree or not, when you're building a house, you're not building the second floor bathroom before you're building the foundation. And the foundation of any sound financial plan is protecting your family with affordable term life insurance. Because if anything happens, game over. You don't have the insurance, and the whole plan goes to dust. Second level of protection is you want to have an emergency fund, you want a budget, you want to have a will. Then comes debt elimination, next retirement, then college savings, and then other goals and dreams. And I know, we're all guilty in some ways that a lot of times we're planning that next vacation more than we are our retirement or getting out of debt. So, and then a good rule of thumb, we'll give you a little more in-depth teaching on how to determine how much insurance you need. But good rule of thumb is 8 to times your annual salary in life insurance coverage. And that comes from the Wall Street Journal in 2006. So the question I have for you, on a scale of 1 to 10, 10 being the highest, how would you rate your desire to become properly protected, debt-free, and financially independent? Now I hope it's a 10, and I know if you're like me, you're like 50. But if you're still with me, let's move forward. So just I don't know if anybody ever heard of the real estate model, but you have this is how real estate agents and brokers structure their pay plan. So if you're an agent, you're going out and you're selling houses, and a typical brokerage fee is 6%, and that gets split with the broker. The agents are going out, and they, after they sell X amount of houses, they can become a broker, but the broker will get them licensed and trained so they can do their job, and they can actually be a broker. So for the broker's benefits of doing that, he has more time and security and unlimited income. The agent doesn't have as much freedom because they're doing the hustling to get to be a broker maybe someday if they want to. They don't have as much security and limited income. So in this sample, you take just a $100,000 house, the typical brokerage fee of 6%, and so the commission would be $6,000. And so you have all the agents, 5 different agents at the bottom, all sell a house. They split the brokerage fee with their broker. They each make $3,000. The broker makes an override of $3,000. So the broker has 5 agents earning $3,000 a month. They just sell one house. So the broker earns $15,000 a month. The agents each earn $3,000 a month. So again, the broker's getting them licensed and trained. It's not like he's just showing up. He's doing the work too. But the question is here, in this scenario, who would you rather be, the agent or the broker? Again, this isn't a trick question, but you'd rather be the broker. So really, our company is looking for people that want to be the broker. And so in our company, the agent would be like a district leader, and the broker would be the RVP in this example. So if you remember our example from earlier, John and Mary, that had cash value life insurance switched to term, you see before Primerica is on the left in the red, and they had the $150,000 each in life insurance for paying $218 a month. We didn't tell you in that example, they also had a retirement account, an IRA at the bank at 1.5%. And some of you today might say, hey, that's pretty good. But anyway, they have $25,000 in there. They were putting in $100 a month. So at age 65, at 1.5%, they have over $97,000. And so after doing a financial needs analysis with Primerica, their life insurance doubles. The kids each have $10,000 on them for a total monthly cost of $98 a month. It's $120 a month in savings. Again, these samples are all hypothetical, depending on your age and insurance costs. They're going to be different, no doubt. And then the same, so they have $120 in savings on their life insurance. They take that, they add it to the $100 that they were putting in their IRA. They roll the $25,000 into a mutual fund, and like if we set it to 10%, so their total monthly contribution is $220 a month. So at age 65, at 10%, they'd have over $1.2 million. So you can see the big winner here, John and Mary, their family. Now, but how do we get paid? So the district leader, on the life insurance portion of this, we get paid $543 a month. On the retirement portion, the investment portion of it, get paid $435 a month for a total of just under $1,000, $978 a month. The regional vice president, writing the same business, on the life insurance portion, we get paid $1,260 a month. On the retirement portion, $771 for over $2,000 a month. $2,000 on this case. Not a month, pardon me. So but the really exciting part of this is the RVP, as we said, it would be like the broker in the real estate model, and they override the commission on the district leader. So their override, if they have a district leader outright in business for them, just like the agent does for the broker, is $1,053 a month. So if the RVP has 5 district leaders writing, one of these cases with like John and Mary every month, they're making over $5,000 a month on override. Plus, they can write their own business. And so, that said, how many district leaders do you want to get when you're an RVP? As many as you can, right? So, what's the next step? Here's the next step. We want to do a financial needs analysis, and we have 21 ways of finding cash for people. So if you're worried about how do I get money to invest, we showed you one way is by saving your money on the insurance, but we have 21 ways, and we typically save married couple with children anywhere between $1,000 and $2,000 a month. And I can tell you that most of the people that say you can't save me anything, we save even more. Also, like to go a little one-on-one business briefing. You could come to our office, meet our people that are around you, and further your education. There's a lot more things, but this is the most basic thing that you learned today to get you started on your path to financial freedom. And finally, who else do you know that could benefit from this? Take some time, write down some names and get this information to them, and we can start them on the path to financial freedom. Stay tuned for information on how to follow up on what we do next. Thank you. Okay, at this point, you are probably saying to yourself one of 3 things. Hey, how do I get started? I'm interested in the business. I'm interested in doing the needs analysis. So what you want to put in that I'm interested in the business on the next after this presentation is over. If you're just interested in doing the needs analysis, want to dip your toe in, just say only interested in the product. And then, of course, hey, it's not for everybody. Maybe you're happy with your situation. Just put in not interested any further. Fair enough. We part friends. Fair enough. Okay. Bye-bye.